during a very interesting period of time, both in our industry, in the U.S. economy, and across the world, to be honest with you. Today, I have a special guest, Logan Mohtashami. Did I say that correct?
Yes.
Good. I've been practicing. So Logan is on the West Coast, but made a concession to be with us this morning. And we are very excited about this conversation because as we all saw yesterday with the Fed's decision to make an emergency move to lower the Fed funds rate and also add some quantitative easing into the system, there has been an overwhelming reaction both by the market and consumers, and everybody's very curious as to what's going on. So Logan, help us understand the impacts of yesterday's decision and how it's playing into the market this morning.
Well, we have to go back to what happened last week. And, I had to do a Twitter live over a weekend and said that was a complete meltdown in the mortgage industry last week, in the bond market and mortgage rates and everything. The velocity of that down move and the rise in yields, but the fact that mortgage rates went up 1% really from Monday to Friday shows to me that, I understand the capacity constraint discussion and it does make sense, but I really think this was an all-out attack to prevent massive EPOs from happening, because when the 10-year yield goes from 194 to 32 basis points, if we had a more fluid mortgage market or bond market, mortgage rates would be at 2.75%. And the kind of recessionary mortgage rates that I'm looking for would be 2.25 to 2.75%. I'm not sure if we'll get there, just because I think that the system cannot take that kind of losses. So what the Federal Reserve did is they did not like what happened last week. They didn't like the bond market action, they didn't like the mortgage rate reaction to it. So not only did they do emergency interest rate cuts, but they are coming in to provide some liquidity. They're going to do MBS purchases, bonds, and in a sense, they say it's not QE, but it's designed to try to calm the markets down. Because what happened last week was just utter chaos. I've never seen something like that in my 24 years.
How do you think today the MBS, I believe, is up 200 basis points. What are we going to see today with mortgage rates on that? Do you think it's because of the EPO issue? We won't see that translate?
Unless I see a 2 handle on a 30-year fix nationally, then the EPO market is preventing rates from going down. And that's, when we get to 32 basis points, because my technical recessionary yields range is negative 21 basis points to 62 basis points. I was looking for 2.25 to 2.75%. The problem is that the velocity of this virus, and we're seeing it now, the reason the stock market is down is the Fed had to do that because we're going to be on shutdown. Once you start implementing policies of social distancing and casinos start to close and companies are told not to be open in full capacity, the downdraft in economic activity is going to be historical for Q2. So that they did that because the economy is about to get hit for one quarter tremendously. So I'm not sure if we're going to get a fluid market, because rates have been slowly coming down for some time, but to get that kind of velocity to where the bond yields are, you just have another wave of EPOs come in. So you're looking at basically a lot of loans in 2019 and in 2020 getting hit, and even people that just recently refinanced, they'd be looking for lower rates as well very quickly. So I don't believe we'll get that kind of fluid mortgage market.
What do you think about when we talk about social distancing and we talk about some of the things that are going on? There's a lot of dialogue that came out of Washington, D.C. this weekend, and it was on Meet the Press yesterday, that the leading advisor on all of this, on the response to coronavirus to this administration, was saying that things like a national lockdown for 30 to 60 days, domestic travel restrictions or bans, all of these things are currently on the table. And in some areas, we're already seeing those types of things. But when we start thinking about that, this becomes much bigger than the mortgage industry, and this becomes a situation where, does the market shut down? Does business as we know it halt until we are on the other side of it?
I think it'd be best for Freddie and Fannie and lenders to get a cohesive plan to talk about what we should expect, because I'm expecting the builders to even stop production going out, and this doesn't mean that people aren't going to go out and buy homes. Obviously, an open house isn't going to be an event of 50 more, but we are going to have so much chaotic headlines and economic output falling that it's not going to be clear, because credit in theory should tighten up, right? In theory, there's a lot of companies who should be, having their credit lines taken away because the stress is there. So I'm not sure how they're going to deal with this, but they need to be clear, because, how do you verify income on a person who's not working? There's going to be a lot of people who are just told, take 30 or 60 days off. Stuff like that is fairly new, because it's something very short term out here. I've kind of looked at this as the next 3.5 months were basically World War III versus this virus. It's not just America; it's the entire world against this one enemy out here. But going out, if you're trying to verify the job of someone who's told, hey, listen, we're not actively working, how do the banks think like that? And I think that's something that there needs to be a kind of a national ordinance given by Freddie and Fannie, because this is a very unique time in economic history. So we need to have more clear rules on how to address with this. In terms of the what we're talking with the economy and housing, purchase applications just had 7 straight weeks of double-digit growth. But if people are now, hey, I'm not going to buy a house, I'm not sure what's going to happen, we need to wait and see how the consumer reacts, because people can still buy homes. You're not held back on that. But the amount of economic damage that's about to happen in Q2 is probably going to scare some people off.
Well, I think, I was whiteboarding this weekend and thinking about the things tactically within our industry that are not being communicated right now. So things like you have recorders' offices across the country starting to shut down. So the ability to record deeds and notes are going to be an issue. You think about this from a perspective of all the servicing platforms. They are not, they're going to be shutting down soon as well. So now the ability to get a payoff becomes a thing of consequence, both on the purchase transaction when it comes to sellers payoffs and obviously on a refinance transaction. I had a conference call over the weekend with 3 very large appraisal management companies that are telling me that appraisers in certain markets are refusing to go out into people's homes, and vice versa. Consumers are not willing to let those individuals in their homes. Same thing with the notaries doing refinances. So you have all these unintended consequences. And then big picture, the things I think about is like, you got 2/3 of Americans that are living paycheck to paycheck in an environment where, if there is a work stoppage due to this virus, how does that impact their ability to make their mortgage payments, their credit card payments, and just live? And for me, I think that this is going to require not only Fannie, Freddie, Ginnie, but this is going to require systematically everybody saying, hey, we gotta freeze everything, because if we start reporting delinquencies on debt, if we start reporting certain things that have long-term implications to consumers, it could really result in some type of credit meltdown.
I believe the mortgage delinquencies, those things are going to be taken care of. In fact, you actually see banks, servicers talking about, what, right away, let us know that you have a issue with the coronavirus. So that is one. I'm more concerned actually for renters than mortgage holders. Renters are typically, have more struggling cash flow issues than a traditional homeowner now. So that aspect, I think, should be looked at. But I'm already seeing banks start to send out, hey, if you have a coronavirus problem, let us know with your credit card. If you can't make a payment, let us know. So this is such a fast-moving virus in terms of the economic damage it's going to do. I think we'll get answers in the next 2 weeks. Slowly dripped out, but we should get answers on how we are going to deal with this. And like I talked earlier, we need a kind of a national game plan for the lending industry, because there's a lot of things that are just not going to be working normal out here. It's one thing with the government shutdown where you might not be able to get some information, but this is titanic in its nature. for the economy, for the lending business, for the housing market. We just need more clarity so we don't waste time on certain things that just are not gonna be fluid for us.
Got it. And that makes sense. So here's my question for you. Like our audience for the most part is a loan originator. So one of the, obviously yesterday after the Fed announcement, Facebook feed is full of, basically loan originators, I'm guessing trying to get out in front of their customers and saying, hey, Fed rate move doesn't mean that interest rates are going to be lowered to 0%, false alarm.
You mean there's no 0% 30-year fix?
Apparently not, if I'm looking at my Facebook feed. so how?
I was thinking after the lab, we had like many years of zero interest rate. I mean, that, this is the best way I would tell your the LO officers. Listen, we had many years of zero interest rate policy, and the 10-year yield has been, the mortgage rate's basically been 3.5% to 4.5% during that entire time. So that's the fastest and quickest way I've been able to explain that we've had zero interest rate policy for years, and mortgage rates have gone up and down in that kind of range. But yeah, right off the bat, hey, what is? Can I get a 2% mortgage or 1% mortgage?
So help like, and it sounds like a basic question, but the Fed funds rate, explain it to a loan originator in a way that they can explain to their consumers so that they understand that this is not, I know it sounds basic 101, but easy peasy way of explaining, like, hey, this is what this cut means to you.
If you're credit cards, if you have a home equity line, if you have an adjustable mortgage, those things get adjusted. The 30-year fix is not something that gets adjusted with a Fed rate hike or a rate cut. Okay, long-term bonds, mortgage-backed securities, those things move 30-year fixes. But think of it as if you have a home equity line, credit card, and an adjustable loan. Those three things will be impacted. That's a simple way to explain it to people that have those products, and don't kind of go anywhere else outside of that. Keep it just in that frame. If your credit cards, home equity lines, and adjustables will be impacted with rate cuts, the 30-year fix, no. And one thing that I've talked about for many years, if you look back when we had QE, actually after the first quantitative easing, people had a misconception. When QE was actually taken off the marketplace, the 10-year yield fell. A lot of people don't know this. It's when QE2 was put into effect, the 10-year yield actually went up. Why? Because people are anticipating better economic data. It's when QE actually came down, and I actually have a chart for this. I'll share it with you. The 10-year yield fell, so it had the reverse effect. People were thinking that, well, when QE is here, mortgage rates, bond yields, these things kind of move with economic data, growth, more or less. So when QE left us twice in the last two phases, the bond market actually fell because of economic weakness, as it should have. And then when we had QE, some of the economic strength came up. So I'll pass that along to you, so people don't get, if they all of a sudden see the 10-year yield not get back to 32 basis points and it starts to creep up again when we have fully impacted the worst of the economic data, then that's the reason why, is that the bond market is trying to get ahead of economic data. And you can see this for many years. If you work off GDP, manufacturing data, that's where the bond market works off of. It's more or less the economics of what we're having here and around the world.
So question for you is, if you're a loan originator today thinking about what could happen, potential shutdowns, state quarantines or whatever, are you thinking about 60, 90-day rate locks when you're quoting customers? Are you giving them the option and preparing them for what could happen? What's the best way to prepare consumers?
If the lenders are offering and they should be, if we really have capacity constraints, you should be telling everyone no 15 or 30-day locks. You should put all your pricing at 60 to 90 to 120 days. Okay, I think that's something that the lenders have to work with in terms of, if this is going to be the case, then let's make our better pricing into 60 or 90 days, so we don't even waste time with people that are going to 30. Because we're going to have this for some time now, so we should have lenders kind of get together and go, listen, let's just kill the 15, 30-day lock and make it 60, 90 to 120 days and get an idea. This is why I think it's good for everybody to kind of have an emergency meeting and think about, how are we going to do this if the process is really going to start to be delayed. Because we all know this, refinances get secondary treatment.
Yeah.
It's the purchase market that is going to be more impacted because you have a timeline. So real estate agents are going to have to also get a heads up that if this process is going to be longer, then don't do your 14, 21-day escrows, or say we're going to get this done quick. Things are changing so fast that I'm not sure if we're going to get the information out to everybody quick enough for this week or next week, because the velocity of this virus is truly epic. I mean, we went in like 3 weeks ago. March Madness was still here. The NBA was here. The MGM casinos were open. They're shutting it all down.
Yeah, Disney World. I mean, that's what I try to tell people is if you go back 3 Mondays ago, then 2 Mondays ago, and then last Monday, and now you look forward a little bit, we're still behind the 8 ball. I mean, as of this weekend, travel from international travel was still on the table and is still currently on the table. So
Disneyland was open yesterday.
And that's unbelievable. So like to me, we're getting to the point where we still haven't actually taken the necessary action to mobilize this situation, and the worst as far as change is probably ahead of us at this point.
Yeah, that's why I think it's crucial to have an emergency national meeting between the lenders and Freddie and Fannie and try to figure something out here, because jobless claims came out last week. It went down. We had back-to-back weeks of lower jobless claims that people are telling me, wait a second, nothing's really happening out here. It's not, the economy is not getting impacted. No, it's looking forward out. You have to be able to realize that the storm is coming. There's nothing we can do about it right now. We're just going to have to weather it. And it's better if the government and the banks figure something out to give everyone kind of a level playing field so information could be disseminated. I think that's the key. We need to get information out to everybody, but we all have to be working with the same kind of game plan, or else it's not gonna be cohesive enough. And just right now, it's just too chaotic. But the faster we get this information out to everyone, so everyone has a level playing field, the better it would be. And I do expect this. I do expect the builders to basically halt production as well. I think when you have this kind of event, everything is on the table. When the government is telling you to stay home, and they're telling bars to close off, everything has to be put on the table, and we have to act like everything is kind of in the worst case scenario, so information gets out. So if it gets better, then we're already dealing with the worst case.
Yeah, and I would say the last component of this, which is really a tough thing, is because it's an election year, it puts everybody in this unique kind of. There's a lot of strategy. There's a lot of political, nonsense posturing that's going on, where instead of focusing on just problem resolution and communication to everybody at the consumer level, there's been a little bit of a dance that's gone on, and I think that's probably a miscalculation.
Unfortunately, politics is the word itself.
Yeah,
politics.
Yeah,
many blood-sucking parasites. That's what it is. And in an election year, I mean, it's just now. One good thing is that I think we finally got to the point that everyone realized this is an issue, and we're going to attack it. Like we're going to attack World War III. And I am actually very confident that by September 1st, if I'm trying to model things out based on South Korea or China or everything, if we're doing all these things, if we're addressing it like it is a war, by September 1st, the virus news is going to be much better. The next 3.5 months, we're gonna have these increasing cases. It's going to be the headlines are going to be crazy. There's going to be we're going to have terrible economic numbers, but it should be very short term, and you'll see some type of, not maybe a full V-shaped recovery, but something a little bit better in Q3, and then by Q4 we go back to, and I call it BC, before coronavirus. Yep. And before coronavirus, the economic data was fine. The economy was moving. People were going to school. People were watching NBA games. We had March Madness. We could do all these things. We need to weather the storm to get through there. And I think everybody in the business community and the governments has a responsibility to try to disseminate the most useful and factual information at this time to try to push things through. Because this is something that we are all part of as a team right here.
Yeah. I agree. Right now is you gotta put competition aside. You have to put everything aside, and the only focus needs to be coming together to figure out how to best troubleshoot these issues and control what you're in control of. And I think there's, I would like to assume that at the national level or at the state leadership levels, they're doing that. And I think within the industry, we have to take those same steps amongst leaders just to make sure that we're preparing originators, consumers, and all of our teams to weather the storm. So Logan, we appreciate your time. We're going to wrap it up here. Hopefully we'll be doing this again very soon. The situation and the conditions.
Hopefully better.
Yeah, hopefully better, but things are changing at such a fast pace. I was originally planning on talking to you on Wednesday, but thanks for accommodating and talking to us this morning, and we'll continue to stay in touch.
Thank you for letting me be here.
You have a great day, and everybody have a great day.